Hi, everyone. Clark Alexander from Pure Funding. Hope you're doing well. We are going to do something a little different than we do in our normal Pure Perspectives podcast style interviews. Today, I'm going to break down the differences between the three most common ways you can access equity in your property, right? A HELOC, a home equity loan, also referred to as a HELOAN, and a cash out refinance. What are the pros? What are the cons? With interest rates going down, we're starting to see more interest in these products, consumer debt going up, people wanting to eliminate high interest debt by accessing the equity in their property. One of these three options can be a good solution. So let's jump right in. A HELOC. What is a HELOC? A HELOC acts like a credit card. You can secure the funds, the equity you need in your property and have it available when you need it. You typically have a lump sum to start. You can pay that back, and we can talk about the different loan options with different initial draw amounts, but it does give you flexibility. If you know you're just going to need chunks of money over time, it is a good solution for you. The cons are it's typically a variable rate, so rates can go up, and it's not ideal if you need the lump sum all at once. That would lead us to the next one, which is a HELOAN or a home equity loan, which is a lump sum loan with a fixed interest rate and steady monthly payments. And that's really what the benefits are, right? If you know you need a lump sum, you can access it through a home equity loan. You know you have fixed rate security. You know what your payments are going to be. The cons are it's less flexible than a HELOC, and you get a lump sum and that's it. So, if there is an overage and you don't have that flexibility, it doesn't give you that. And then the third option is a cash out refinance. And a cash out refinance is where you're replacing the existing mortgage on your property. So let's just say you have an outstanding mortgage of $500,000 on your property. You want to access $200,000 worth of equity in your home. Your new loan amount becomes $700,000. So it does let you access equity while potentially lowering your mortgage rate depending on when you purchased your property. If you purchased during a high interest rate period, you can lower your interest rate along with accessing capital. The cons are you can see higher closing costs. And you're restarting the clock on your mortgage, which is not that big of a deal. If you need access to your equity, it can be an affordable way to do that, especially if you're dealing with some high interest debt. Credit cards, north of 25%, it can be a very smart financial tool to allow you to eliminate that debt and increase your cash flow on a monthly basis. So hopefully that helps just give you a quick overview of what the three differences are: the HELOC, the HELOAN, home equity loan, and a cash out refinance. Give us a call. We're happy to walk through your scenario, talk about rates, talk about structure, talk about initial draw amounts on HELOCs. We're here to help. Just leave a message in the comments. I'll get back to you as soon as possible. And I look forward to talking to you guys in the near future. Have a great day.